Welcome to PipsTalk, where we explore the fascinating world of the carry trade strategy. This technique allows traders to profit from interest rate differentials between currencies. Understanding the carry trade strategy. At its core, the carry trade strategy is about capitalizing on the interest rate disparities between two currencies. In essence, you borrow funds in a currency with a lower interest rate and invest them in a currency with a higher interest rate. The goal? To earn the carry, which is the difference between the interest you earn and the interest you pay. The components of a carry trade. To execute a carry trade successfully, you need to consider several components. 1. Currency pair selection. You'll need to select the right currency pair. In a carry trade, you typically go long, buy the currency with the higher interest rate, and short, sell the currency with the lower interest rate. 2. Interest rate differential. The interest rate differential between the two currencies is the heart of the carry trade. The larger the differential, the greater the potential profit. But remember, it's not just about the difference in rates. You'll also want to consider central bank policies, economic conditions, and market sentiment. 3. Leverage and position size. Leverage can amplify both gains and losses in a carry trade. So, it's essential to manage your position size carefully and use leverage wisely. Many traders use conservative leverage levels to reduce risk. 4. Risk management. Like any trading strategy, carry trading carries its own set of risks. Exchange rate fluctuations, geopolitical events, and economic shifts can impact your trade. Set stop-loss orders and consider diversifying your portfolio to manage these risks. Executing a carry trade. Now, let's walk through the steps of executing a carry trade. Step 1. Research and analysis. Start by conducting thorough research. Identify currency pairs with favorable interest rate differentials and solid economic fundamentals. Consider factors like inflation rates, unemployment, and central bank policies. Step 2. Choose your currency pair. Once you've identified a promising pair, it's time to choose your currency pair. Remember, you're looking for the currency with a higher interest rate to go long and the one with a lower rate to go short. Step 3. Enter the trade. Now, it's time to enter the trade. Open a long position in the high-yield currency and a short position in the low-yield currency. Set your stop-loss and take profit orders to manage risk and lock in potential profits. Step 4. Monitor and adjust. Once your trade is active, don't set it and forget it. Keep a close eye on market conditions, news events, and economic data. Be prepared to adjust your trade or close it if the market goes against you. Step 5. Collect and reinvest. As time passes, you'll collect interest on your high-yield currency. Depending on your strategy, you can either reinvest these earnings or withdraw them as profit. The risks and considerations. While the carry trade strategy can be profitable, it's not without risks and considerations. 1. Exchange rate risk. Exchange rates can be volatile, and sudden fluctuations can erase your gains. Be prepared for market ups and downs. 2. Interest rate changes. Central banks can change interest rates, impacting your carry trade. Stay informed about monetary policy changes. 3. Liquidity risk. Some currencies may have lower liquidity, making it challenging to enter and exit positions at favorable prices. It's crucial to consider these risks when implementing a carry trade strategy. In conclusion, the carry trade strategy can be a powerful tool in your Forex trading arsenal. When executed wisely, it allows you to profit from interest rate differentials between currencies. If you found this video informative, please subscribe to PipsTalk for more insights into Forex trading, strategies, and more.